Hello, this is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. With this Analyze Out Loud video, I'm going to take a fundamental look at United Natural Foods, Inc., a company that I would like to build a case that I believe is currently very attractively valued for a capital appreciation or recovery story, if you will. I'm going to start by looking at adjusted operating earnings. I can look at 5 different earnings metrics, but in this particular company, I'm going to look at earnings before interest, taxes, depreciation, and amortization, and adjusted operating earnings. Because what I'm really trying to determine here is how's business, how's this company performed historically as an operating company from a reported or adjusted operating earnings point of view. The company's been semi-cyclical. We've had an occasional dips in earnings, although it did go through the recession of 2001 with really some great results. It had a minor dip in earnings in the Great Recession of 2008, but then it followed that with a string of really good earnings growth. And then we had a little hiccup coming into fiscal years 2016 and 2017. And as you can see, their fiscal year ends in July, by the way, and they'll be reporting their fiscal 2018 results in a couple of weeks. So this is the orange line in this graph represents a fair value reference of a PE of 15, which is kind of normal valuation for a company with an 11% growth rate. Now, next I'm going to go ahead and put monthly closing stock prices on the graph, because the idea here, this is an earnings and price correlated graph that we're currently looking at. And you can see in the long run, price did go where earnings went. However, there were periods of disconnect where the price got significantly high. So I want to put another valuation reference on the graph. I'm going to put a calculated normal PE, which is in English the PE ratio that the market has most commonly applied over this time frame as a reference. So this blue line now on the graph represents a PE of 24.2. And as you can see, there were times when it was trading above that 24 multiple, and I would describe this as periods of overvaluation. There were periods like coming into the Great Recession where it did get down to this normal, 15-ish valuation, but then when we had this great string of earnings growth here, we had a steadily increasing PE ratio that ultimately culminated in a PE of about 30 towards the end here in February of 2015. And then as we came into fiscal years 2016 and 17, we continuously saw a string of weaker earnings reports, and there were a couple of reasons for that. Currency exchange rates of the Canadian dollar versus the US, as well as an accounting error that the company had made. And so they ended up with 2 soft years of earnings. You can see they had a 9% negative earnings growth, and then they had a minus 1% earnings growth in 2017. But they are expected to recover, and so far after reporting 3 quarters, they seem to be on track for something approaching a 20 to 25% increase in earnings. And again, they'll be reporting this in about 2 weeks. The quarter's already closed, but it'll be curious to see what it is. Now, they also made an acquisition. They also have purchased Super Value Foods, and that has, I think, caused this most recent drop in stock price, where it fell from a PE of in that 15 range down to its current blended PE of 10.8. So you can see the market typically values this stock pretty highly. We had a hiccup in earnings that created a complete reset. If you just calculate this roughly, this company's price fell by over 60% from February of 2015 to February of 2016, and then it's been kind of just bouncing around earnings ever since. Now, I also want to look at this company from a standpoint of EBITDA, earnings before interest, taxes, depreciation, and amortization, and I see that EBITDA has averaged about a 10.5 EBITDA. This orange line in this particular calculation represents a 10.5, 10.5 EBITDA, and you can see the correlation between price to EBITDA has been very profound. In fact, if I scroll out these current years and the forecasting years, you can see that this company has tracked this 10 EBITDA, and it was a constant. Every time it got above 10 times EBITDA, it reverted to the mean, and every time it got below it, it reverted to the mean. And you see that pattern repeating itself over and over again. But now as we go out into the more recent times and then look into the forecasting going into the future, we see that we now have this stock trading at a very low valuation. It's reticent, kind of similar to what we saw in 08 and 09, where the price to EBITDA got down into the 5 range where it currently is right now. That was the bottom, and that's currently where it trades at. And so if this stock were to recover back to a 10 EBITDA, just as a what-if scenario, you could see a 50% annualized rate of return out through fiscal year 2020, which ends in July, obviously. The company is an interesting company. It has about a $1.7 billion market cap, 1.8. has 18% debt to capital. And from a valuation perspective, there are a lot of ways to value a stock. If I look at price to sales, this company has historically, when it was trading normally, traded at about 0.5 to 0.6 times sales. Those have been, 0.67 has been the highest price to sales. It's currently trading at 0.19 times sales, and you can see sales or revenues have actually been doing quite well. So I'm going to go into the financial underlying numbers here and just look at the company from a standpoint of revenue. You can see the company's consistently grown revenues year after year. They've averaged almost 12%, 11.9% revenue growth going back to 1999. If I shorten the time frame more recently, it's consistent at about 11% growth in revenues. In fiscal year 2017, they grew revenues at 8.9%. And if I look at the last reported quarters, we see this consistent steady increase of revenue. Revenues, went from $46 a share to $52 a share in April, and they're expected to be up again for this coming quarter. Going back to the fast graphs and looking at operating earnings, I want to take a little look at the future and see what analysts believe are going to happen with this company going forward. So I'm going to turn to our forecasting calculators, and I'm going to first look at it from a standpoint of this more market normal or neutral, if you will, normal PE of 15, what the market historically has traded at for hundreds of years. And, on that basis, if this were to revert to the mean, you can see that it's traded at much higher PE ratios than that several times just in the last couple of years. You got these very intriguing annualized return potential. It could average over 26% annualized by the end of 2020. It could average over 19% by 2021. But I also want to go to the normal PE multiple here, and I want to take a look at how the market has historically valued the stock. And you can see there was a period of time where you had the market consistently trading it at a multiple of 20 times earnings or better. Starting in 5 years ago, the PEs dropped to 18. I'm going to use this 16.8 as kind of a middle multiple. So this blue line now is a PE of 16.8. If it were to revert back to a 16.8 multiple where I got some multiple expansion and I got the earnings growth, it's expected to grow about 24 to 5% this year, about 9% next year. There are 18 analysts in those universe. In 2020, there are 9 analysts expecting 4.8, and then by 2021, we really lose the analysts. So, if I'm looking out here to where there really is a true consensus, you're looking at very high rates of return for the next year or two on an annualized basis based on the company going back to a more normal valuation level. Since these forecasts are based on analyst estimates, I'm going to go check the analyst scorecard where FastGraphs analyzes how accurate the analysts were when they made the forecast 1 year in advance with a 10% margin of error, and how accurate analysts have been when they were making the forecast 2 years in advance. And as a summary, analysts have been correct about 80% of the time within a 10% margin of error on a 1 year forward forecast, and they've been accurate about 60% of the time. So all that's telling us is that, there's a reasonable expectation that these estimates might be in the ballpark, but I also would point out that this is consistent with their normal growth. Instead of using analyst estimates, if I use the company's historical growth rates and go back here and look at it, the long-term growth rates of this company have been in that 10 to 11% range. More recently, it's been growing at 6 or 7%, but that was including those 2 down years we saw in 2016 and 17. So if I just kind of pick a middle of the road, I'm going to use a 9.5% growth rate and assume that the company grows at that rate over the next several years instead of estimates. I still have double-digit rates of return here. So running a lot of what-if scenarios, if you will, I think this is a very attractive value investment opportunity to buy a stock at a very low value. Of course, if we were fortunate to see this thing go back into these high 20 PEs or mid 20 PEs, our annualized rates of return over the next couple of years would be extraordinary. Similarly, if I went back to the estimate multiple and went up into these 20 PEs, you could see you could have 35 or 6% annualized returns. Anyway, this is my look at United Natural Foods. I think the company's an interesting company. It's got some really good growth potential. I think the Super Value Foods distributor acquisition is going to be a big plus for the company. So I really like it from a valuation play with recovery potential going forward. If you like what you saw with FastGraphs, you can give us a call at the number on your screen here, or check us out at www.fastgraphs.com and take a look at the Fundamentals Analyzer software tool. Thanks for watching.